Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started.
Phil Bowes is the founder and CEO of Accrue, PLC, a business that specializes in helping institutional and retail customers earn high interest on their cryptocurrency. Phil has more than 15 years of leadership experience in the fintech and asset management sectors and having spearheaded the scaling up of online trading platforms at several leading companies. As an expert in financial planning and wealth management, Phil spent 4 years during his time at a UK robo-advisor, Wealth Wizards, speaking to over 10,000 retail investors about how they manage their money, and then designed a simple online tool to give advice and guidance to help everyday people improve their financial health. He's got a very impressive educational background, which I'm not going to detail here, but you'll see in the show notes. He's passionate about improving the financial health of all those he meets, and is the author of a personal finance book, The Money Triangle, proceeds of which support various financial educational charities. Phil, welcome to the Deal Quest podcast.
Thank you very much for having me. It's a pleasure.
Well, Phil, listen, we're in an interesting time. I will tell the listeners we're recording this in the middle of June. So who knows in this market what's going to happen? 2.5 months could be an eternity. But we'll just to give you a place and time. But before we get into, obviously we mentioned, your fundamental business is in crypto, which is why I made the comment I made. We're going to talk about some stuff around, raising money through SPACs. But before we go to all that, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because I'm sure running a fintech company in the crypto space was not it back then. But you tell me. I
must admit, I got asked this question before, and I realized I probably wasn't the most traditional child in certain respects, because I used to take the newspaper, like the local newspaper, and read it in bed at like 8 to 12 years old, but I wasn't reading news. I was reading the job adverts, and sort of working out which were the higher paid jobs and things like that, which is a really odd thing to do in kind of retrospect. But but it was always interesting. Looking, what's that big job? I'm 12. Am I qualified for that yet? Probably not. Something. And I don't really know where that came from, if I'm honest. But in terms of what I probably wanted to do early, I loved the idea. I always said that I wanted to have a job where I could earn a reasonable wage, but not have to wear shoes if I didn't want to. That was one of the ideas, like being outside. So I actually went on and did geology at university as my first degree, and it was I did a bit of classroom time, but there's loads of time outside. I had a 6-week trip over in a place called Alapahore, which is back end of nowhere in Greece, and kind of lived there. And me and a few of my colleagues were kind of adopted by a local Greek family, and doing ouzo and feta cheese up at their little property. Is great, fantastic stuff. So it was a really cool degree to do. And I think my father worked in the oil industry, so that probably had that was probably one play on it. And he'd always said, the discovery part of oil is kind of where the opportunity and kind of money is. So if you're going to get into the oil industry, do that, because he was more on the sales and marketing side. And but it didn't pan out that way. But I had a lot of fun just wasting time, out in the digging through rocks and taking samples and things like that. So yeah.
What a great journey. It's always interesting. I love asking that question because it's always interesting to see what people are interested in and how they came to where they are. And once in a blue moon, there's a straight line, but it's almost never the case.
Yeah.
Good stuff. So one other question looking back, and that is, what was your first deal of any type that you can remember? It could be something small when you were a kid or early in your career, just an early deal that comes to mind.
I think, I started off in kind of in sales really. And, my first kind of deals were helping people move money abroad. So it was very much retail focused type thing. In terms of the deals that I did very early, it was all very, very, retail focused kind of sales. So helping people. I think it was helping someone buy a property in Dubai was probably the first one. So, first job out of uni, that was kind of the first thing I did, which was, helping, this person came to me saying they found a property, but wanted a really easy way of, the banks were ripping them off in terms of the money that they wanted to charge to convert it over to from at this point GBP over British pounds to dirhams. Help them kind of structure a better exchange rate, get the money over there, and then help them with parts of the deal. So that was probably one of the early ones. And, you get a taste for it there, I think. Yeah, and met some and spoke to some fascinating people. Trying to, because again, putting yourself where the money is always really interesting. Because these were individuals who were buying incredibly expensive property abroad during the sort of 2005 to 2007 kind of property or boom time at that point, the tail end of that first that run up from the which grew from the dot-com bubble bursting. And it was just learning from these individuals as to what they'd done to get to the point where they could buy multi-million-pound properties abroad as second homes was a fascinating learning experience.
Right. So we gave a quick overview in your bio, but just give us a couple of minutes on what Accrue does and what the core business is and who you serve.
Yeah, so Accrue is essentially an app where we're taking the fairly complex world of crypto and trying to make it accessible and safe to the everyday investor. Increasingly what we're finding is, crypto it's created its own lexicon that's confusing everyone. So our job is just to demystify all of that and make it very, very accessible in the consumer app. So customers come to us, they can deposit the major currencies, like normal currencies, or they can put existing crypto holdings onto the platform. And we help them earn the highest interest rates that they can find in the market on those. Many people who get into crypto, crypto 1.0 was sort of buy Bitcoin, hope it goes up. Crypto 2.0 is, look, this is kind of a financial ecosystem that's flourishing. And, it's quite difficult to understand if you're a novice to the space, but it works in exactly the same way as the traditional financial markets. You can lend assets, you can borrow them, you can use your assets to do all sorts of things that you would. And I think trying to help people through that process and do it safely is really what Accrue's here to do. And I think increasingly with the way the market has evolved, especially in the last month or so, it's opened up a huge amount of opportunities to kind of broaden that and give some different products, which we've launched in the last couple of weeks, which have landed very well despite market conditions.
Great. And listen, we'll talk a little bit about market conditions. How can we not? But before we go there, so you also, and we'll talk about market conditions about this thing we're about to talk about as well. But you had a major deal where you raised capital, right?
Yeah.
Can you talk us through that? Like it was pretty early on in the company's.
Yeah.
Give us that journey there.
It happened in two stages, really. So we always talk about being PowerPoint to PLC, or publicly traded company, in 10 months. That was kind of our roadmap. And so we started it off, and I'd been kind of doing the MVP, the minimal viable product of Accrue for probably a year. And we got to the point where we were comfortable pitching external investors. And we kind of did the pre-seed or pre-product round with friends and family. It was it was a good time to raise. This was sort of January of 2021, and the market was picking up, and especially in crypto. And there was obviously decentralized finance as a concept was becoming more widely known in the investor community. Pretty first time founders, myself and my co-founder Digby. We got out there, spoke to our friends and family, and we raised $1 million in pretty short order. So we did that, but I think I'm delighted that we did it. We knew straight away that, look, this is an opportunity. Accrue is, I believe, a $1 billion business in the making. But it's a competitive market, and it's one where it's investors want to see strong balance sheets, and credibility is very important. So the idea came and the opportunity came along towards the tail end of that sort of first $1 million seed round, which we closed out and got over the line. And that sort of allowed us to hire the staff, build the product. But then we got this sort of 3-month discussion where, one of our contacts said, well, we've got a listed vehicle, which is trading on the UK Aquis Exchange, which is sort of one of the junior exchanges in the UK. But it's sitting there. It's got 7 investments already in it as a business, which were just minority stakes in other businesses. But it's got £8 million in there, and we would love to see that become more of an operational business. And Accru's a really good fit. It was there to support decentralized finance. We got to know the team that had put the SPAC together, and they had a very, very strong track record. They'd founded a company called Argo Blockchain previously, which they took from scratch to over $1 billion valuation. It's now trading on the Nasdaq. It's not $1 billion at the moment, given what's going in the market, but at its peak it was. Sure. And and they'd done this almost a dozen times before. So very, very strong team. Thought they could add a lot of value to the business, and we haven't been disappointed. And enabled us just to do the deal very quickly and strengthen the cap table in a very significant way. Which, given the market conditions we've now got into, we've always been very conscientious with our kind of cash burn and things like that. And we were looking at a high growth, but now we're saying, well, this is a market which doesn't really lend itself to really putting oil on the fire and aiming for because we were growing at 100% a month. But
wow.
Spending a lot on marketing as well at the same time. So now it's a case of, okay, well let's balance this out. Investors are quite bruised by this market environment. So let's make sure we can conserve the balance sheet, then ride the next wave, which we feel is going to come in the next kind of 12 to 18 months. So yeah, it put us in a really good position now, and I think the credibility of being a listed business, having a stronger balance sheet, is why I think we're gonna do well as crypto markets pick up, tail end of next year.
Yeah, so it's interesting, right? Because the evolution of companies goes differently, right? In different markets, even funded companies, and there's always this question of speed to market, speed to raise capital, being able to accelerate stuff, but also sort of versus raising too much too early and maybe giving it because the valuations aren't. Do we bootstrap it or friends and family, to a certain level to get higher valuations, and all that kind of stuff. But, I'm guessing certainly at that time, you hit the market, at the right time with in the right vertical, right industry, right? So that you probably, and you don't have to disclose obviously anything confidential about the deal, although probably some of this stuff because your public company is available. But I'm assuming you had somewhat at least the best of both worlds in that you got speed of capital and also probably nice valuations as well. Yes.
Yeah, I mean, for a young company, it was a good valuation. Given that we were at that point still pre-launch. So it paid off in terms of the business growth, but in terms of the market's opinion of crypto and SPAC public companies, it's that's an area where I think this latest move has been really interesting because we were looking at ourselves, about 3 or 4 months ago, probably a bit more, say at the start of 2022. And, our competitors are almost further behind us. Mm-hmm. They are raising in the private markets, they're raising additional finance at 5-10x what we are, which, so there's a huge sort of public private market discrepancy, which, I think the markets come down, but, both markets have come down almost evenly. But, we were over in Austin last week for a big kind of Ethereum conference. And, even with what's been going on, there was a deal everyone was excited about, which is a pre-product deal, raising at a valuation of 180 million. That nothing's been built. It's a white paper. That's all it is. So, the private market, early stage kind of mania is still there. I think there's ways as a public business that we can still, have the best of both worlds, as you say, which is we can spin out other businesses and take advantage of private financing and private market valuations. And, looking if this premium continues to exist and we can, we've got as a business, there's dozens of product lines that we can look at. That's a really attractive option that we can incubate these kind of companies, spin them out as private, raise them and then IPO them themselves. And I think that's quite an attractive strategy that I think, this kind of discrepancy in valuations is going to, I think we're going to increasingly see that.
Yeah, very interesting. So listen, we've alluded to the market, to the crypto market, to the SPAC market. And you and I had a brief conversation before we went on air about, likening aspects of this to, you said to me, hey, I was I was managing money or financial advising on money, through the 2008 global financial crisis, 2008, 9, 10, whatever it was. And then I've been around long enough. I mean, I remember Black Monday back in the 80s, but but more relevant here, the tech bust, right? Internet bust, in 2000, which if you think about it, I mean, I just was drawing some parallels in my mind. Obviously, there's a panic a lot of times. People run from the market. The weak players, weed out. And there were even people back then. I'm talking about in the 2000 range who was saying, oh, internet's dead and whatever. Of course, we have the perspective of 20 plus years since then. And I mean, was there a shaking out? Sure. Did the weak players go? Sure. But obviously, we know what's happened with the internet generally, and we know what's happened, with some of the survivors of that time. Maybe they had to pivot, et cetera. So, I mean, I'll just say up front that I can't imagine that the same pattern is not going to happen, in this market. But you know the market way better than I do.
I mean, I could be, I will be the first to say that 95% of crypto projects, coins, will die. I think, but I also believe that the 5% left over will change finance, forever. So. Yeah, I think that when investors are looking at the space, they should come with that kind of mindset. 95% of what I'm hearing about in crypto is never going to go anywhere. Identifying the Amazons versus the pets.com, is sort of the way to do it. The way I always think of it as well, which seems blindingly obvious when you say it, but like when I speak to crypto investors and they're investing in some coin that they've just told me about, I'm like, well, do you use the core product? So it sounds, and if you don't, do you know anyone who does? And usually it's no, and so it's like, well, what do you use? Well, they just say, oh, well, I bought an NFT the other day. Okay, great. Well, how do NFTs work? Well, they're on the Ethereum blockchain. So in order to buy that NFT, you had to buy Ethereum, and it's sort of like, so it's, Ethereum has this value, Bitcoin has value in the fact that it's just, everyone sees it as the OG sort of like, crypto coin with it's truly decentralized, it's a store of value and these sorts of things. But outside of Bitcoin and Ethereum, you really need to do your homework, because there's a lot of stuff out there which is really difficult to look at. I mean, really difficult to justify in terms of valuations and things like that. But I love you mentioned the 87 crash and October 87 I think it was. These are things that I love looking back, because for me, like obviously it's market conditions change, but understanding, the past sort of booms, bust, manias is really important. I always have the stats in my head for these sorts of things, especially with what's going on in finance now. But the average sort of bear market in the States, peak to trough of 33% is sort of what you see on average. It takes sort of 18 months to kind of come out of that bear market on average. So that's like 150-year kind of average. So we're sitting here at the moment, and the S&P is down 22% from its highs. Nasdaq's down 33%. So it's like, okay, is it going to be an average bear market, or is it going to be a nasty one? You could argue, with the scale of the unwinding of the Fed balance sheet that we're going to see, it's it could be worse than we expect, and we haven't seen inflation for a while. So but it kind of gives me some comfort about around what the expectations, and sadly you can do the same thing in crypto. So it's a much shorter market, but as I said before the call, crypto is like traditional markets on fast forward. The pace of innovation is sort of 10x what you see elsewhere. So like 1 year in crypto is like 20 years in finance.
Right.
We've seen 4 bear markets before, and on average you're looking at around about an 80% drop in prices. So everyone is running around going a bit mad at the moment, but Ethereum's down 70%, and Bitcoin sort of around about the same, so 70% drop. So we're not at the average yet. And let's be honest, we've never seen crypto in an inflationary environment. So there's a whole lot of other things. But I'd always say, like, the thing that's really interesting, which is coming into crypto, which I think is people should really reflect on here. The tech hasn't changed. The problems it's trying to solve aren't changing. And we're seeing people like JP Morgan. There was a great headline. JP Morgan loads the $1 trillion bazooka, is what I quite liked. I thought it was a great headline, but they're talking about bringing all of this kind of like unused collateral on chain to make it useful, and I think that to me is like, there's 2 things I think are going to drive the next rally in crypto. It's, it's things like that. It's the use of different collateral types to and bringing what are currently dead assets into the financial, onto the blockchain. And also regulation. When we see regulation really clear about what institutions can and can't do, all of this institutional capital sitting on the sideline is going to come flooding in. And what we've seen so far in crypto is really just the hobbyists, the early adopters. We haven't seen the real money come into the market yet. So that to me is like, that's going to take some time, but that's what I'm kind of excited about in crypto.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to corykupfer.com/assessment. That's corykupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
So there's so much I want to talk about because it's so interesting to me as somebody who does have some decades of perspective on the financial markets of various type and also the tech markets, that kind of stuff. And has had clients throughout that entire time and has seen the ups and downs. First of all, with regard to regulation, I agree with you. I mean, there's no question that crypto is going to get more and more regulated, like everything else does. In my mind, that's what my regulatory colleagues in the legal profession help politicians do, which is to some purists, right? I mean, it's really the anathema, right, of this decentralized, unregulated, non-central bank, non-Fed Reserve, all that kind of stuff. So that's there's a whole tension in that conversation. But at the same time, you're absolutely right. I mean, when that happens, then more traditional and institutional money becomes more comfortable coming in. So. But it's interesting because there's an ethos behind crypto, right? That is in conflict with it, right?
Yeah, I mean, it really is. And I think, the hardcore kind of libertarian view is that, this is like hands-off markets, regulators should not be touching this. But like, there's just bad actors in the space. You've seen it everywhere. If you delved into some of these new protocols, there's just predatory activities going on that aren't. If you want the average consumer to come in, otherwise it's just going to be professionals who are crypto natives just trying to rip each other off all day long. If you want kind of like more passive capital that's there to invest in the coins into the space, it needs regulation and it needs protection. And you need, there's a lot of, people love the anonymity of crypto and things like that, but you shouldn't be trusting billions of dollars to people you don't know who they are and their backgrounds. And one of the biggest sort of protocols we saw out there. There was we saw that something like $3 or $4 billion worth of customer assets there, and then it all crashed to zero because someone unmasked the person who was running it. It turned out they were like a convicted fraudster. But in a regulatory environment, there's a fit and proper test for someone who to make sure that personally, if I give someone money, I want to know where they are and who if they rip me off, who to go after. Right? It's sort of like it adds a big layer of accountability to the space. And I think it's all very well people saying, it's the regulators are going to overstep and things like that, and they probably will do initially.
No question.
It will open up more opportunities. It will bring capital to the space. I speak to big investment banks, and that's always what they say. Is like the reason we're not in this space is because it's not clear from a regulatory perspective. So, unless they think like there's going to be a shadow economy that's going to grow out of nowhere and everything's going to move, against regulators' will, and we're all going to sort of do this. This kind of gray market, which I don't think is going to happen. I think it's more that we're going to see blockchain tech merge with traditional finance. And that to me is the bigger opportunity. You've got to welcome the regulators. You've got to work with them to try and make sure that they do a good job and it's all fit and proper regulation that they put in.
Yeah, no question. And listen, I agree with you that that's the inevitable trend, whether you like it or not, right? And listen, I'm not a guy who's a knee-jerk anti-regulation guy, and I'm not a guy, I have these conversations sometimes with folks who are very strongly in one position, and when you speak to them, there's always regulations they agree with, like there's a law that says you shouldn't kill people. They generally agree with that, right? That's a law. That's that's restricting your rights, right? They probably agree you shouldn't be traveling 130 miles an hour down a side street, where kids are playing, right? So I mean, I don't want to get into that whole conversation, but the point is that it's always a matter of the degree of regulation and what type of regulation. There's no true any regulation person out there that I'm aware of, at least, no matter how libertarian they are. But also, you see it over and over again, right? History will tell you that, the regulation is going to come. And listen, frankly, what'll happen is what happens every time. Yes, there will be some over regulation because regulators tend to react to the bad stuff, and that which creates burdens for the honest folks in the industry, whether it's disclosure, paperwork, or reporting or whatever. It's just part of the game. So yeah, I think the biggest thing is for the industry to try to do the best they can to have the regulations be appropriate and tailored and not too burdensome, and address the issues that are legit.
Exactly. I think what you find is like when there's a misunderstanding of how sort of the various segments of the market connect together, there's all these usually unintended consequences from certain types of regulation, and I think that's an education piece, which, there's things around like where you've got developers who are helping build DeFi protocols and decentralized protocols. And people are saying, well, if you're a developer who's done that, then you're on the hook, that's sort of like, that's something where it wouldn't happen if you built a bit of a bank software. You wouldn't expect to be on the hook if that bank then went and sort of, didn't use it how you originally intended. So, yeah, it needs to be careful. I think we've proved, especially in the last couple of weeks, is all very well in a bull market when everything's going up. But, just as Madoff came out in 2008, I think it was, or 2009, when you see when you see prices drop off, that's where everyone's dirty laundry comes out. So, it's sort of, that's what we're defending against. And regulations are kind of there for the bad times, not the good times. That's where they really show their value.
Yeah, no question. The other sort of theme that comes to mind for me is, you talked about obviously Bitcoin and Ethereum, on the one hand, and then, sort of really having to do your due diligence beyond that. Even with them, it's interesting. So now I'm going in my mind to the tech conversation, right? And early leaders in various tech who are not don't end up being the survivors, right? So people have heard the examples over and over again. I won't give them. So it's an even interesting question as to whether whatever level or the 2 or 3 after that of the crypto and blockchain world is, whether the Bitcoins and the Ethereum's the current leaders will be the ones there.
It is. You're right. It's an odd situation that we're in because if you compare it to like the MySpace got was out of business, and Facebook, and it was the first one kind of made all the mistakes, didn't get the adoption, and then the second one was could just see what the issue was and go from then. We sort of saw that a bit with Bitcoin was there, it's very fixed. It's nothing's going to change Bitcoin. It's fixed forever. The code is law. It's there. It's what's called proof of work. Nothing's going to change that. There's only ever going to be 21 million. The purists love that because there's nothing you can tamper with it, that sort of thing. But it's quite like a dumb protocol, and that's kind of where Ethereum appeared, where it's like, okay, well, we want to be the internet of money, and right. The unit of which is going to be Ether, and everyone knows ETH, and you're going to be able to program apps on top of this. And it's much more of like there's a lot more utility that you can get, but sort of, so you'd think, well, that has a purpose alongside Bitcoin, but it's weird that the two haven't, and we've there's a lot of what's called layer one solutions, which is they're kind of trying to compete with Ethereum because Ethereum has a lot of issues, both primarily transaction costs. If you're trying to basic transactions, they can cost $15, $20, which is ridiculous if you want to build an app that's kind of a mass payment app that you can use for, for micro payments in the shop. It just doesn't work because transaction costs are too high. So a lot of people have come out and said, well, we're going to build new sort of consensus models on brand new chains. So things like, Near or Ava or Avalanche or Solana and things like that. But they're all, and they all need to find their own level of adoption as well. I think that's going to be a slight challenge because even Ethereum has struggled with adoption. And now we're saying, actually, there's going to be a multi-chain world that, we need to do. So there's quite a lot of barriers and sort of to sort of scaling and the network effect that these competitors have to get by. And given the current market conditions, everyone has just gone back to safety, which is the Ethereum blockchain, and all of these other alternatives are going to struggle until people want to take the risk of different chains, or they do something that's so innovative that it forces people away, and they haven't really done that yet. So it seems to be why they're there.
And sometimes then I'm wondering, is actually, I don't know the answer to this question because I don't understand the tech side enough. In other markets where there is a shakeout, what you see is acquisitions, right? The stronger competitors buying up the weaker ones on discounts. But, if we're talking about different chains and different, what is your thought on whether, we'll see any of that happen in the marketplace?
I mean, it's an interesting question. I mean, I think it does, yeah, because it does feel like there is a barrier to DAOs, decentralized autonomous organizations. It feels like there is a big barrier, and it's a big tech barrier for these companies to merge. It's much more common that they just die and the assets move.
Yeah.
Because what's really interesting about blockchain is the code that builds these new apps. It's completely public, and you've seen it with people just doing copy and paste jobs on each other's protocols over and over and over again, to the point where it almost stops innovation, because people think, well, I can make a quick buck by just copy and pasting this, rebranding it, and doing X, Y, and Z, maybe putting it on a different chain or something like that. It's weird, because like the value is actually the community with a lot of these protocols, and that community can almost weirdly can be almost be a bit fickle, and it's difficult to sort of judge the value of it. But I think, and if you look at kind of the crypto centralized space where, exchanges and things like that, there's been very little M&A there as well.
Yeah.
Seems to be people buying specific technology or, specialist services, but none of them, would Coinbase merge with Kraken or Binance? It almost feels like it's too much of the same thing. There's not, it's like, you just get more of the same thing. And this is probably something that you're better placed than me to answer. But it's, when it's like there's not a lot of kind of, complementary businesses out there, because it's an exchange adding an exchange is just adding more of the same. And I think that's, maybe I'm wrong. I'm missing something there, but it doesn't seem like it's a particularly active M&A environment at all.
Yeah. And, that's sort of why I asked the question. I mean, that was my sense, right? Like, unlike, it's tougher to compare this to other situations, other industries where there's been some challenging economic times, and there is a lot of consolidation because the stronger players buy up the weaker players. My sense is a lot of these technology and other things would be in the way. But again, I know enough. I understand enough of the technology side of blockchain and crypto to not even to be dangerous yet. So that's why I figured I get but I did have a sense that might very well be the case. So that's interesting, because it creates a different market, and and can there be value salvage for any of those assets? Now they do have users, right? Customers, whatever you want to call them. Maybe there's an opportunity. I mean, those deals aren't as lucrative, but to just combine in for the purposes of getting access to customer lists, but in any case, so let's go back a little bit to your core business. And so how does it work when most people think about getting interest on a financial, asset, on money, on whatever it is, right? On equities, whatever it is, only a couple of ways usually it's done. I mean, either you're depositing, again, in the normal, currency markets, you're depositing money at an institution that holds that money and then gives you interest on it, or you are at least putting it up as some sort of collateral, right? Where they can access it. So tie that into how actually your company and product work.
How does it work? I mean, there's two questions we get all the time, which is how do you generate the yield and what are the risks? And they are the right questions to be asking, absolutely. Yeah. And I think it's fair to say, if you look at the wider yield landscape, and everyone does not generate yield in the same way, and the risk profile is probably poorly understood by a lot of investors. So we've recently this week we've just seen probably one of the biggest players in the lending, crypto lending and yield space, Celsius, close withdrawals, and some serious questions being asked about their solvency. And that's because they from the surface, and obviously this is all speculation that we have, and no dispersions cast, but it appears that it's just a classic liquidity trap that they've got themselves into, whereby essentially they customer A gives them an asset. Yep. They need to generate yield on it. So just like a bank, they will lend out assets to other counterparties, institutions that have capital intensive businesses that need liquidity. And essentially what they've done is they've looked at that, and there's a yield curve in crypto as there is in traditional money. So the longer you lend something to someone, up to a point, say 6 months, the higher the yield you're going to receive for that period. And that's how you manage your book, like a normal treasury operation. But the difference is that the depositor is given instant liquidity. So in the case of some of these large lenders, what you found is that the market conditions have deteriorated, and people have started saying, you know what, I want my money back. And then they've, sort of because everything is so transparent on chain, you can see exactly what these big institutions are doing with your money, how they're lending it. And, there's rumor after rumor where you can see, okay, they put it into that protocol, but that protocol, after they put the money there, was hacked and 100 million was lost. So who lost 100 million? And was it your money? Was it the customer's money? And, and you see 4 or 5 of those happen. You're saying, hold on a second. I know you raised 750 million or something last year, but there's about $400 million missing already from just, what we can find. And all of a sudden the market says, okay, well, let's really go for it. Let's go have a run on the institution, start pulling it out. And obviously, the liquid element of their book then gets depleted. And the only option they have is to cease withdrawals. And, the real hope is that it's just the fact that it's liquidity and not solvency, really. And, they're able to cover themselves. So in terms of how Accrue does it, we are very much 100% transparent. So, when you go to a bank, you deposit your money, they lend it out. You've got no idea who they're lending it to. We've got quite a couple of products on the platform whereby we use third parties. One of them is called Maple Finance, which has sort of pioneered this. And you can see straight away the money that you've put in. You can click and you can see the loan book. Yep. So right away, I say this is the institution, and there's say 50 institutions. This is the interest rate they've paid. This is the term of the loan. We're not taking that liquidity risk. Whereas on this platform, it's a 90-day tie-in for all money. We say to customers, it's a 90-day tie-in. Yes. And you get your yield, and here's who you're lending to. And, there is a credit manager there, but ultimately it's your responsibility to understand if you want to do that. And I think that's kind of the future of crypto, is that level of transparency. I think that will attract people from traditional finance who, throw money into funds. There's been some big scandals in the last few years in the UK where, again, it usually comes back to liquidity. And, you see what a fund manager's doing, and it wasn't quite what you thought they were doing. And, everyone loses their money. So I think that's, we're very, very aware that that's what we want to do. It's 100% transparency. And, and I think, a lot of people think we're giving away trade secrets and things like that, but I don't think we are. I think that's going to be the new thing that people demand, especially in these kind of market conditions. Imagine if you had that level of transparency during the 2008, financial crisis, where you could see the banks, a live valuation of the bank's P&L. Obviously, as we know, a lot of the credit derivatives were hard to value and went from being 100 cents on the dollar to being actually, they're 10 cents on the dollar. But it's
it makes sense to me. And, and as we talked about earlier with, at some point when institutions are going to come in, obviously their level of due diligence is going to be totally different. And even, we represent hundreds of investment advisors, right? Financial advisors, people who manage money in the independent space in the US here. And, and there are a lot of them, some of them are dipping into crypto, but a lot of them, I referred a friend over to somebody and they rejected him because he had too much in crypto, right? They didn't.
Yeah.
He was even like, don't forget my crypto, just manage all this other stuff I got. And they're like, no, we're not comfortable with that. So, over time, obviously, when there's more transparency so that they can do, more due diligence and they can evaluate, the risk and the investment better and the yield curve and all that kind of stuff like they do on more traditional financial products, that also, will free that up. It's tough, especially for somebody who's a fiduciary, right? Who's an advisor. You've been in that world. It's tough for them. They have a fiduciary duty to the client, and if they can't do, and if there's such a lack of transparency, it's tough for them to recommend. I get it. I totally understand.
Yeah. Without diving too much into it, I feel like most crypto, investors just aren't doing it right. They're getting like the highly concentrated version of crypto when they should be getting the balanced version of crypto. And like I look at my own portfolio, and the way I manage it is, I don't want 10% daily volatility on this, and it's a bigger part of my overall portfolio than it would be of any normal person's portfolio because of where I work. But I have 50% of my crypto assets are currently sitting in crypto that's pegged to the value of the dollar, so what's called stable coins, earning a high yield. And then the other 50%, 25% of it is in a trend following system, which what that does is, when market conditions, begin to be positive, it starts adding crypto exposure. So this same trend following model, when Bitcoin was at 69,000 and then it started dropping and dropping, and then it dropped through 60,000, it flipped me into cash.
Mm-hmm.
So right there and then, you've missed the whole decline from 60,000 down to 20,000, and you end up with that model over the last few years has sort of outperformed Bitcoin's return by sort of 5x. And then you have that market exposure, which at the moment, given what market conditions are, is only 25%, obviously losing money, a lot of money on that. Yes. But it's, and I think that, it's basically taking 50% of the exposure to like the real kind of like nasty crypto, like swings. The average investor should not be doing that all in, but obviously, I think a lot of people fans, they put money in to begin with. It went up so much, it became a massive part of their net worth. Right. And now it's just gone back down again, and it's, pretty soul destroying stuff for a lot of people who are overcommitted.
Yeah. And listen, again, that's not you've seen people do that. I mean, I remember when I was just started out as an attorney, it was back in the day, and I had an office on, in Manhattan, and I would get calls from all of these brokers trying to sell me on some hot tip stock to put a chunk of money in, and take a concentrated position on the next whatever, maybe before Facebook and Instagram and all that stuff. So there's investor approach, diversified portfolio versus trying to beat the market, time the market, pick stocks, whatever it is. You're talking about the same mentality difference, right? In a different, in a different vehicle. So
same human nature, isn't it? It's always the just carried across different asset classes.
Yeah, absolutely. We're coming to the end here. So before I ask my final question, just let people know. Well, actually, a few things I want you to make sure they know. Who's your typical client, right? What kind of person, are you looking for and would be a good fit for you? Where can they find out more about your company? And then if you want to say anything about your book, mention that, and then we'll go to the final question.
In terms of our average customer tends to be, an investor who is like a time poor investor who has had has got an existing portfolio, wants to get into crypto, understands, look, this should be no more than 5-10% of my portfolio, because it's been the best performing asset class in the last 10 years. So, I think I should have some exposure to it, over maybe bonds or something like that, which are probably improving. But, so that would be our average customer. And, someone who wants, they want a bit of hand holding through the process, and, they're happy to, we've got a really easy to use app. So, obviously have a bit of technical expertise there to be able to just download it. Would be easy to start. In terms of finding out more, Accrue, aqru.io, is our website, and I'm pretty active on LinkedIn. I love chatting to people. We've got a Telegram group as well, which is great. And we've got a really lively community with 50,000 people in it now. So across all of our socials and stuff. So there's plenty of feedback, both good and people telling me to get a move on with stuff all the time. So it's all there. And in terms of the book, I wrote the money triangle to sort of help people just really understand, their finances. So if people are, maybe they're just feeling like they're not saving enough, they don't think their spending's under control, or, they're looking for little, trying to improve their get to be front of the queue when they get the next job promotion, or, looking at, just being able to earn a little bit as a side hustle. That's what the book's there for. It's, you try to illustrate it with lots of stories, like, the Walmart employee that's worth like $30 million, and the, these sorts of things, and the lottery winner that's worth zero, that sort of stuff. So, there's hopefully a few funny anecdotes in there which people would enjoy, and a couple of good messages as well that people can take away from it.
Right, and they can find that in all the usual.
It's Amazon, it's Kindle or Kindle or paperback. So just check it out. The Money Triangle on Amazon.
Excellent. Phil, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom from all people around the world, from oppression, to why I'm an entrepreneur and haven't had a boss in 30 years. There's an aspect of freedom that underlies some of the crypto, ethos as well, right? What does freedom mean to you, and how does it impact your life and business?
Freedom for me is really just being able to choose how I spend my time. And really that's the core of it. In terms of how that is reflecting our business, I try to respect people's time by, we're a remote business. I tell, we're fully flexible, work when you want, where you want, and take as much holiday as you want. It's down to the management team to create a vision everyone's excited about and that you want to work towards, and clear KPIs as to what needs to be achieved. But outside of that, I employ people who don't want me on their case, and if they need me on their case, they probably don't last very long, because that's not my style, and it's not the culture that we are. So, we're looking for people who want to, they're passionate about their work, but want the freedom to spend their time around, when they're working as they see fit. So, yeah, that's what it would be for me.
Well, Willis, thank you very much for being a great guest on the DealQuest podcast.
Pleasure. Thanks so much, Corey.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.